All right. Good morning, everybody. Welcome to our Q&A session today, April 13th, 2019. My name is David Settle. Glad to have everybody on board here today. Thank you for the well wishes. I appreciate the emails and emails I got over here this past few days, and here in the chats. Irene, I appreciate that, and Florence. So I did have an appointment yesterday with that neurosurgeon, and they scheduled me to get one of those steroid shot injections to see if that will work in my neck. So we'll see. I think it sounded like like surgery. They kind of say that they want to try everything possible before they do the surgery. So we'll try this. I've tried everything else, so we'll try the steroid shot now and see if that helps get things. And they also gave me a new medication. I think that's kind of why I felt I sounded a little bit better. I didn't put the camera on, so I did the video last night without the camera on. But they gave me a new medication that hopefully will, help with the pain, with the nerve pain. I guess I tweeted out that picture that I tweeted out last night. It's almost exactly how I feel. I mean, I feel like I just want to cut my arm off, and that's gabapentin, Scott, something like that, the seizure medicine. So yeah, I just feel like I just want to chop this arm off because it's always just like on fire all the way down my arm. So it makes it a little bit difficult to sleep too. Yeah. So that's what I'm on. To try, hopefully that starts to kick in sometime here, and so this is not so acute because this is nonstop. But anyway, let's go ahead and take a look at at what's going on in the markets here. So give me 1 second to do that. Oh. All right. Share my desktop. That was about 25 pounds ago, boss. So I've got that extra weight now. I got to try to get up off the ground. Gravity is a more powerful force. Maybe like 30 pounds ago. All right, let's move this over here too. I get asked that all the time. I get asked by the kids, "Can you dunk it? Can you dunk it?" And it's like, well, yeah, if I was, however many years ago when I was, 200 pounds or less, and I could get off the ground, sure, but yeah, not anymore. Let's see here. The S&P is continuing just to grind. I've got Phil's question here that we'll start off with in a second. But just kind of, heads up on the S&P is still grinding higher. Don't bank on a Disney type move to come out of this, right? I mean, of course, anything can happen. Anything can happen here, but don't bank on that to come out of this kind of move that we're getting on the S&P 500. So, at some point in time, the intermediate line will come down. I mean, here's the context, right? Here's the context. Like, the intermediate line will come down below 50 again, and this is about the time where you start to see some lower highs or some those divergent low points. Right? This is, we start seeing the near-term line getting into the reversal zone. We're seeing some of the signs already. Timing is getting there. I'm not saying that this week is going to be the week that we start, but we're getting closer. Barring this kind of move right here with the trade deal, barring that. But this was even really, because you remember the tax reform bill was passed over here in 2017, and then the new year started, and we just continue to, that there was all that expectation of all this cash coming back over from overseas, and stocks really rallied on that. So I don't think we'll necessarily get, a trade deal passed, and then like the market's going to just keep going up for multiple weeks straight up like a rocket ship after that. It's not the same, right? We're not going to get the same thing. In fact, I wouldn't be surprised if an announcement towards a trade deal is actually what starts the intermediate pullback, right? That's because that's what we seem to be kind of pricing in or moving up for on those headlines. Obviously now we got earnings season coming through. That really helped the financial markets. I wouldn't necessarily say that the Disney is a selling a call opportunity. That we've traded this before, right? We did it with Boeing to the other side. We did it with Boeing. We traded the Iron Condor and Boeing. We've got a couple other Iron Condors going on Costco and Delta for kind of the same things, right? When they make these big moves, then we put on the Iron Condors because then like the bandwidth, these volatility charts, whether it's the Bollinger Bands, the bandwidth on Bollinger Bands, like that will start to shrink. And when it starts to shrink, the things tend to go sideways for a while. So that's kind of why we've looked at, when we make these big time moves, we look at the Iron Condors for there, because we expect the sideways action to come out of it. And whether it's, like I said, Delta or Costco was one that's made a big move. Relatively speaking, not like that, but relatively speaking. And then of course now you've got Disney, which is just blown through its Bollinger Bands. And look at that bandwidth. Remember, bandwidth, this is a this is a percentage. This is an apples to apples, right? So it's a percentage basis. So you can look at a comparison in the long term. So there's we're at a 16.65. So that's where we're at right now. Higher than the last so many years, and that's a point that we got to a little bit higher at the beginning of 2016 when the global recession was kind of hitting. And you see how we, it kind of stopped the declines that produced that. We went sideways, and then we had that big old decline that we rebounded really sharply off of because it was that extreme of a decline. And then here you had this big move, and we went sideways for a little bit higher. Yeah, that's that streaming service. I think everybody's planning on, especially at that price point. If you have kids, that's the game changer. And then you have the fact that their properties are just generating cash like you wouldn't believe. Infinity War or Endgame and Star Wars, and then you have the parks getting a big boost from this Star Wars land, and how they can't, how they're trying to manage the crowd sizes and kind of open things a little bit at a time to try to keep up with the demand. So yeah, that's a big deal for Disney. I've always been a kind of a guy that's you invest in the things that you like or that you use. Obviously not as your core, not as your only investing philosophy, but as part of what you do. And so Disney's kind of fit that for me, just because I have 4 boys, right, and we, that's a product that we use nonstop. And so, especially now that they'll get that streaming service. And we go to their parks all the time. We watch their movies all the time. We we watch the movies in the theaters all the time, which is a big deal. Um, we we will use that streaming service. We already do, like on Netflix, and um, so it's that's a big game changer for Disney. So that will have an impact on like the Netflixes of the world. Not that I'll get rid of my Netflix, purely anecdotal, of course, but not that I'll get rid of my Netflix, but it'll be interesting to see how many people sign up for Netflix, and I have little kids. I mean, that's the thing is most of the Netflix stuff isn't for little kids. I mean, it's been a nice thing, but I think a lot of people will start transitioning towards that Disney streaming service for little kids, and we'll see how much demand that takes away from the Netflixes of the world or any other streaming app. So, all right. Well, let's take a look. Let's take a look at Phil's question first. And let me get my recorder. 11:05. GD is out over the. Where's my Q&A panel? There it is. Just get this. Okay, GD is out over the skis, looking at the May 1 standard deviation credit strangle, short the 160 and 190 call. The macro suggests the stock should meander along from here. Let's take a look at GD. I did hear, John, that they're going to bundle with that ESPN Plus. That ESPN Plus is going to be an interesting thing. These from a college sports perspective. The TV, this last realignment phase, where schools change conferences, it was really kind of driven by cable households. That's why you have the Rutgers and the Marylands of the world joining the Big Ten, because of big cable markets. But now, in a few more years, by the time the next round of TV contracts come up, cable is not going to be nearly as big of an element as streaming will be. And how big your fan bases are, and that's going to be a much, much bigger deal than the cable households, because the idea behind the cable households is they would kind of push it. Households who didn't watch sports at all would still have to pay for it anyway. Well, now, like the next go around, it will be like how many people, like how much demand actually is there for your product. It'll be interesting to see what kind of realignment comes out and how ESPN Plus takes advantage of that as a streaming service. It's already kind of signing up some of the smaller conferences for most of their stuff, and so that's going to be a nice little bundle to have. Yeah, Oklahoma has that model too, right? And not the same thing, not the same network with ESPN, but I know that they have their own deal. I wouldn't be surprised if the big, how like the Premier League in England has, the top schools. I wouldn't be surprised if the Ohio States and the Texas and the Oklahoma USCs of the world, Alabama, Florida, LSU, all those big time schools, I wouldn't be surprised if they just created their own Premier League and had their own, their own demands, their own streaming contracts for their thing, because the smaller schools within those conferences just don't have nearly the same cachet. All right, General Dynamics. It's I'm on the right stock, right? Okay. It's really kind of slowed down. Here's an example of General Dynamics is a good example of a stock that had that big bandwidth, and then in this case it was two big downward moves. Now it did bounce before going sideways, and now it's almost kind of setting up actually. Was it Phil? Now it's actually setting up for a potential breakout, I would say. You are breaking out right now over the upper Bollinger Band. Let's take a look at what the yeah, we're not getting a whole lot of volume here, so I wouldn't I wouldn't say we're breaking out right now. You do have 3 green arrows and a rising moving average now. You do have let's take a look at the market forecast. You do have the bullish pattern here, and we did close today over multiple weeks high points. Again, not a lot of volume, so big grain of salt there. I don't think it's on the brink. I mean, I don't think it's like this was the breakout move, but I think we're getting close to a breakout move on General Dynamics. It's such a the trend has gone really, really down. It's a long-term trend. We're filling in the gap between the 50 and the 200-day moving averages there. On a long-term basis, the trend had been pretty strongly bearish, and you see when the trend drops hard, when it ends pretty hard. It turns to noise pretty quickly from strong trends. So I wouldn't be surprised actually if this doesn't drop hard this next week towards zero, and because it's the downward trend is, especially with this week's, almost breaking out above even those highs. You're kind of running. It looks like it might have a little bit of a breakout move here to the upside. Right, that's on the weekly chart. If you take a look at the daily chart, it's still very noisy now. Again, that's why I don't think this is the breakout move itself. I think we are getting closer to a breakout move on General Dynamic. And take a look at the DMI, which is another kind of way to identify potential breakouts. So both lines have been trading below 25, little fits and spurts above 25, below 20. But I mean that's a very sideways trending action. But then you can see here the DI plus got to its highest level. Now it got up here and looked like it might break out before dropping into it. And same thing on the downside, we had a little bit of a breakout and then nothing. So it's not, again, one day doesn't make a breakout, but keep an eye on this. The ADX was so extremely low. I don't know what the 29%. That's not too high. It's not really, really low either, but it's not too high. You've got at the money here. At the money, you don't have a whole lot of volatility there relative. You have a $12 move. So by June, you're anticipating a range of not even 10%. So, but more than 5. So you're 5. You're looking at, 6, 7%, 7, 8% of a range, plus or minus above that 175 we're at right now, according. So if you did a long, not a short, but if you did a long strangle, then it would have to break out of that. If you're looking at, like you said, the short strangle, so we go out to May. Because remember that number, 12.5 points. So you go out to May, and you said the 160 on this end, which is 15 points to the downside. So that's outside of the range for June. So that's good. 190 is at 15 points to the upside. So that's, you're not going to get a whole lot of premium. So you're looking at $1.40. I'm getting, close to $1.40. Probably in this 132 range by the time it's all said and done. It's a relatively wide range. 15-cent spread here on the 190. It's a wide range. Now remember, these are nickel increments, so they're going to be relatively wide anyway. But it's outside at 10%. 15-cent there too is also outside the 10%. So you got relatively wide bid-ask spreads. it's expensive stock, and it's nickel increment, so it's going to be wide. But you have to fiddle around here to get the price that you want. So now let's analyze that and throw this on. So again, well outside, even for June. Is it for June? No, you're kind of, I mean, the 15-point move there is 1 standard deviation even for June. So you're outside of it for May. That's good. And then you set those slices to, here, let's just do there we go, 80% odds. So there's your break evens. That's a pretty decent range to sit in. Let's look at the Bollinger Bands really quick, the volume profile. Yeah, you've got a big volume node up above the upper band. I would be more concerned about that upper band, the upper break even right now. The broad market's more bullish, and you are closing Friday above a few weeks high point. So if you had to guess if you're going to break out in one direction or the other right now, I would guess to the upside for those reasons. So you do have a volume node up above your break even up there, so that's going to help. I'm not too concerned about this one to the downside, but you can see how we are at the biggest volume node right now. So even if we do kind of break up here, that's going to be a big support on the downside. So that's going to help you. But again, not as concerned. And again, the maximum reward is only 140, 100. Well, in this case, 132, depending upon what you get. In this case, 132. So you'd have to be willing to take 132 loss, and no more than that. So that's just a little bit below your break even, another $1, a little bit above up there. That's the problem with your really small rewards, is you have to take really small losses. You don't want to take on high probability trades, you don't want to take big losses because it takes a lot of high probability trades to offset a big loss. So yeah, I would say that's a pretty decent setup there. From a technical perspective, you got some help on there, but I think you are on the cusp of a breakout. So I'd be cautious in terms of your risk management. I wouldn't do a whole lot on this. I don't know from a fundamental perspective what might drive a breakout, but from a technical perspective, it looks like there's opportunity for a breakout to occur soon on this stock. Unfortunately, you have resistance up here. If it does break out, that can help you. Okay. You don't have a lot of wiggle room above that because remember, $140 loss. $140 loss is going to be right above that, so you don't have a lot of wiggle room to work with. So that's why I say I wouldn't do a big position here, but I see the technical setup for something like that. So hopefully that helps you, give you a little bit of perspective. All right. Let's take a look at Eugene's question here. Where's my recorder? 2355. Okay, can you tell us the relationship between the S&P and the dollar, or yields? I think you said the S&P goes up and the dollar goes down. The S&P, the dollar isn't the dollar isn't a big driver by itself, but it is. It can be a headwind or a tailwind. Like a falling dollar can be a nice tailwind for stocks. A rising dollar can be a headwind for stocks. It won't necessarily force them to go down, but it can. It won't force them to go down, but it can keep them from going up very much. So yeah, that's the relationship. Is the dollar goes up, the dollar goes down is the best environment for stocks to rally, and usually international stocks rally more. But we've seen the dollar rally in bullish dollar environments too, and we've seen U.S. stocks outpace international stocks for long periods of time. So that's not the only environment. They're just, those returns are more muted. The yields, on the other hand, rising yields tend to have a positive correlation with stock prices. Rising yields do. And so, because the idea is we are in a deflationary environment. And when I say that, I'm talking like from a long-term perspective. This bearish trend that we're on, from a long-term perspective, it represents a deflationary environment. The last big-time inflationary environment we've had was like early 80s, late 70s. The inflation has been dropping down, at least from this yield perspective, for a long, long time. All right, so in deflationary environments, stocks and bonds tend to move opposite each other, right? So it's like an either-or trade. If I'm willing to take risk, I'm willing to buy stocks, and if I'm not willing to take risk, I'm going to buy bonds. So it's an either-or trade. In a inflationary environment, stocks and bonds tend to move together. So we're in the environment now where they tend to move opposite. So that means yields in the S&P tend to go together. Now that hasn't been the case, right? Lately, like you look at here, let's get rid of let's see, let's do 63 and do TNX up here. So you can see, and let me give you some context here. So here is the positive correlation. So over the last 10 years, it's been above zero longer than it's been below zero. But we are below zero right now, right? We are, you can see, and you've seen that before. This move here in October, yields rallied, and then stocks started to fall and yields stayed up. That was the relationship there. Then they both came down. Here's another period. Stocks and yields rallied at the beginning of 18, and then they both yields, the stocks really came down and yields didn't, and then they both rallied, off of that March-April low point. Over here, this is the election, right? And so right before the election, yields were rallying and stocks were falling, and then they both rallied coming out of it. So, there's going to be a big move one way or the other, where they're both going to make that big move, according to what we've seen in the past when this correlation has been this negative. The question is, which way? Which way is it going to be? And I'm not a doom and gloomer, so I don't think we're going to crash. I don't think the market's going to crash. I don't think yields are going to go up a lot. I think yields have a chance to make a run towards this 2.75 area, and stocks can continue if we can break out above that 2940. In the market outlook, I showed you how in 2017 or 16, how we broke out the all-time highs barely, and then that's what we finally got the intermediate pullback after coming off that sharp low point, the death cross in early 2016, and we bounced up and broke out above to all-time highs again. Then we had the intermediate pullback after such a long run up, similar to what we're getting now. And so we can probably make a run up here where both yields rally up to 2.75 and stocks grind higher towards all-time highs again. before we get the intermediate pullback where both of them fall, and that would still get this rising up towards higher levels. So that's kind of what my expectations are. Now, whether that actually ends up being the case or not is a different story. But I can see us slowly grinding higher while yields move towards, a resistance area before they both pull back. And in that environment, since they're both moving the same direction, even in both directions, this line will move back up towards the top where it generally spends most of the time. Right? Not only does it spend most time above zero, but it spends most of its time up here. It peaks up above this half, 50% plus correlation. So that's the relationship. TYX is not, it's just kind of the same thing. You see it's a lot more volatile, but you also see too, you see that it has bigger swings up and down. It's a little different than TNX. TYX isn't. It's a long term, so it's not as beholden to Fed policy. It's more beholden to how Fed policy might impact economic growth. So that's a factor, but it's not really beholden. Where TNX is more influenced by the Fed policy, as well as economic growth expectations. And remember, Fed policies now, they're not going to raise rates anytime soon. They're not going to raise rates anytime soon here, by the end of the year. But they're also not going to cut rates either. So the raising rates is a result of rising inflation and rising, economic growth, and the lack of cutting rates is the idea behind that. So this is kind of like Goldilocks. In my opinion, this is like Goldilocks environment for the markets, to have no rate hike odds and some rate cut odds, but not a high probability. And this, again, remember, this isn't the next meeting. This is by the end of the year. So, and even into January, you got a little bit higher odds of a cut, but still less than 50%. So, in my opinion, and this is just me, so take it for what it's worth, but I think this is the Goldilocks environment. The environment, like I said, back in 2006, when they stopped raising rates, and they didn't cut rates until for more than a year later, and in that time frame, the stock market rallied more than 20% in a year plus time frame, a stock rally of 20+%, because this is the environment where the Fed's not raising rates anymore, not putting any pressure on that yield curve and short-term rates, but the economy is not bad enough yet that they need to raise rates, and that's when we're getting closer to recession, is when they feel like they have to, cut rates down. So TNX is more influenced by this. TYX is not. So, and more people look at the 10-year note. That's by far the more common one. So support and resistance levels will be stronger on TNX. So I think, you have a negative correlation now. I think it's going to turn positive as they both, as the market kind of still grinds its way. And there's no bearish catalyst right now for stocks in the short term. Everything is kind of pointing to the upside. Now, I'm not, remember, when you get to the point where you think stocks is going to go up every day, that's when you get the big pullbacks. So I'm not to that point yet where I think stocks are going to go up every day. I do expect there to be a pullback sometime soon, but I don't think we're extremes right now where that pullback is imminent. I think we are on a nice grinding move higher, and we've hit this 2900, and now we've gone through the 2900. We're at 2907 over here on the left, and so we've got a little bit more room to go before we hit the all-time highs again. And that's just in the S&P. Of course, in we've got some room to go on the others. The Dow's got a few, it's 27,000 is the big number there, and then The NASDAQ Composite's closer. 8,000 is a big number for it, and the Russell 2000's got to get above 17. It's got a long ways to go there, so it's not even above its February highs. So that's a little bit of a red flag for me, but not one to sell off everything today. So those are the main relationships. And so the dollar's not really going anywhere right now. If it breaks out, it had a down day Friday, it's had a down week, but if it breaks out above 98, it doesn't mean stocks can't go up. It will mean that U.S. stocks will outperform international stocks, but it will also mean that stocks will have some pressure. The dollar will only go up because in my opinion, because those rate hike odds will go up again. Right? The dollar will break out above 98, in my opinion, only because rate hike odds will jump up again. The Fed, whether it's inflation or whatever, there'll be a renewed market expectation for rate hikes. That's what's going to push you through 98, and that will pull yields up too, especially the 10-year yield. And that will not necessarily weigh on stocks. It will get you that intermediate pullback if it's soon, if that rate hike odds jump up soon. But it won't give you a bear market in equities. It will just, U.S. equities will outperform. So we will have to make an adjustment in our portfolio, for our portfolio management class. But I wouldn't necessarily say that we're going to head into recession because of it. So remember, recessions start when the Fed cuts rates, not hikes rates. When they cut rates. Right? Yield curve inversions don't start recessions. Yield curve inversions usually end the rate hike cycle, and then it's the rate cut cycle that usually starts recessions. And not that it starts it, but it just means that it's a reflection of it. It's a reflection that the Fed needs to do something because economic environment. And I've shown you this chart before. The economic surprise index, it's not the strongest. It hasn't been updated for Friday. We got a few things out on Friday, but the consumer sentiment, but it's still pretty darn negative, and that's not the most bullish environment for yields. So that's, again, I don't think. But if this rises, that's gonna help yields rise too. But if it rises, and I don't think we're rising like this again. I wouldn't be surprised if it rose like that. So the last time we were in this kind of global recession, where 2015 we were low here, we did rise up to zero and then it kind of stayed in this area before we finally broke out. So that's I wouldn't be surprised if we rose up to zero, and that helps yields get back up to that resistance level. And then what it does after that's that's going to be the different story. You break out, yields might break out, and then if it breaks out, your interest rate hike odds will break out again, right? This number will start to go up again, and then that will cause your 10-year yield to go up. And again, that's usually bullish with stocks, right? Yields and stocks go up higher, and stocks can go up, they just won't go up as much. And especially it will put pressure on emerging markets, right? See, we have emerging market positions, that bigger position in emerging market stocks and bonds in our class portfolio because of the expectation that the dollar would actually drop. So that's why we'd have to make some changes there. And then also from a sector rotation standpoint, a strong dollar is really good for the consumer. So you'll have consumer stocks do well, but not so good for the industries that we were expecting to do well in a weak dollar environment. So like industrials, they don't do as well with strong dollar, and energy and materials don't do as well with strong dollar. All right, so we'd have to make some adjustments there. All right. Let's see, Ron's question. 39.15. CLT made a recent short-term high and has since pulled back. How should one evaluate the current? Well, there we go. We kind of had this discussion a little bit. So I think so we didn't look at TLT though. Let's take a look at this. Okay, so TLT, again, it's on a bullish long-term trend. You've got the golden cross. We've pulled back towards the 50-day moving average, and we've actually pulled back towards from a technical perspective. You know, like these highs right here. See that? So there's some support in this area. Let's take a look at the Bollinger Bands. So there's some really strong support in this area on TLT, and we're pulling back towards it. There might be a little bit more of a run to the downside. And like I said, TNX has potential, which is, well, TYX is the opposite. You know, it's kind of made a run up towards it. So it's, you know, it's going to meet up some resistance at 3%. That was a big support for it. And it fell below 3%. So now, you know, 3% is going to be a big number for it. So kind of watch that number, and that's going to tell you what TLT is going to do. Whether it's going to hold that support or not. That's going to be your equivalent to 3% on TYX, not TNX. TNX is more IEF, the ETF IEF. TLT is more for the TY. This is the 20-year plus, so this is going to be more similar to what TYX does. Yeah, we've had a pullback to support, and I think there's a good chance that that support can hold, because you expect support to hold until it doesn't. You know, now whether it will trend higher, you know, again, it trends higher, and when yields fall, and I don't think necessarily that yields are going to fall sharply here, like by the end of the year. So I do think there'll be some pressure on yields. It will keep them from going up, but I wouldn't expect more of a sharp drop until the Fed starts cutting rates, until those odds of cutting rates get above 80% and stay there. So don't expect a big long-term move to the upside out of TLT yet until the Fed is in the rate cutting mode. That will put some pressure. Quantitative easing mode, that's what drives bond prices higher. But I also, even if the markets are really bullish in the end of the year, which I do expect, I don't think you'll have big drops in TLT, as I don't think yields are going to make a big run to the upside anymore. The Fed's not hiking rates anymore. Until those rate hike odds start going up again, I wouldn't expect a breakout on yields. Okay. So that's Ron's question. So a little bit of a discussion on both those there together. 42, 40. All right. As earnings season approaches, I like to try some BWB to take advantage of high volatility with the downside bias. Can you help me? BWB. Mike, remind me again, BWB, what does that stand for? Broken wing butterflies. Oh, okay, sorry. The downside. Let's take a look at Netflix. So you're thinking that they're, on earnings we could drop to the downside. Now, I haven't done a lot of broken wings. I usually don't do a lot of those on earnings. Let's see, what would you be looking at this April? We're probably looking at this April here. April for the earnings announcement play, short-term play. I mean, that's what I would be looking at for other earnings type options trades. I will admit I don't do a lot of broken wing butterflies on earnings. I do more of the straddle strangles. But yeah, so you do. Let's see here. Let's see. Let's sell. You've got the. I assume you're looking at the put side of things. Call side. Okay. And you said 330. 20, 27, and then what are you getting on the 360? 9. And correct me on any of these that correct me if I've got any of these wrong on there. Okay, that's what I thought. You were getting a little bit of a credit. Oh. Let's take a look at, you got your market maker move at 24 points. It's about what your straddle is right now too. Your at the money straddle is about 28 points. That gives you a move down to 320 plus, and you said we're at 330. Yeah, I mean, yeah, you don't have any. The move to the downside, the 340, I would. So again, grain of salt, right? Take this for what it's worth. In my opinion, I would highly doubt. I mean, I think you're more likely to be in this area. I highly doubt that we're going to stop here at here's 340, right there on Netflix. And again, that's just me speaking, and that's, it might be, I'm heavily biased by the move that we saw on Disney and the impact it can have on a company like this. Because remember, Netflix is going to lose a lot of its catalog from Disney by the end of the year. And it's not going to impact earnings right now, but it will be interesting to see what the market thinks in terms of what kind of guidance that the market itself gets out of this earnings going forward with that news in mind. So I actually think you have more room to the downside here than even 340. I mean, 330, you've got, that's the one that you bought down here. That's where you kind of your next volume node is, and that's 20 points away, and that's still way inside the straddle price. So if you go like the 320, you have a little bit of a node here. You don't have much support, but there is some at 320, 325. If you want to try to move this down over, or even, let's see, you still get a credit if you move to 320, or let's say 325. You get a little, no, you don't get much of a credit to make it worth it anymore, do you? Well, let's see, what's your $600? That's actually not a really, I would say forget this potential here, and 387 out of 609. I would say that's your trade, and just shoot for that. I think your risk to the upside, which is here 354, your break even to the upside. It would have to get back through this big volume node, and that is a possibility. And you can see you got your maximum loss there. It's not the greatest reward to risk ratio. I mean, I think on a trade like this, Mike, your odds, it's not the great. This isn't a great reward to risk ratio. It's 400 to 600. And I think you have a really high chance of getting the 600 if it does, unexpectedly. I don't think it will, but if it does break out up here to the upside, then that you're highly likely to take that 600. So with that in mind, I wouldn't position size too big for this, because you're not going to be able to contain to a small loss. In my opinion, you won't be able to contain yourself to a small loss if it doesn't work out. But I think you have a very high probability of a decent reward on this. I mean, it says 57%, but in my opinion, I think you actually have a higher probability than that to the downside. So yeah, Usually on these types of trades, you would like to see even a higher probability than that, but you're going to give up reward, like I was showing you when I go to the 325, and when I buy the 325 there. You're going to give up, and it doesn't really give you that much higher of a probability. You have to go out on this call even further to. So it starts to push things out more. So you can start to finagle things around here to try to get things better. You try to go for a high like in the 70s here on these kind of one-sided butterfly spreads. But in this particular case, I think you actually have a decent setup to go for that reward, the 400 to 600. And just because you're so likely to take the 600 loss, I would cut down your normal position size and go for and don't worry about that. A lot of people will try to line that up to where they think it will get to. I wouldn't worry about that. That's your lottery ticket, and highly unlikely you're going to be at 340 by the time all is said and done. I actually think it'll be closer to 325 in this area, but we'll see, right? We'll see what happens. So some people, if that was the case, they'd try to move this over to 325 and make it work that direction and try to go for that like 1300. That is a good reward to risk ratio, 1300 to 600. But the odds of getting 1300 are minuscule. So it's not even as high as like a long call vertical or a long vertical would be, or a long call or a long put would be. So it's disregard this and just shoot for anything down here. But keep in mind too, keep in mind here, you're going to have to finagle to get, you're not going to get 391, so you're going to have to kind of finagle to see what you can get in this area here. See how much you can get, because it is a pretty wide spread, and big expensive stock, wide spread. Okay, so hopefully that helps you there. A wide spread's another reason to have a smaller position than normal, because a wider spread means that you're even that much more likely to get a loss that you don't want. You won't be able to get out quickly when you get to the loss that you're willing to take when you have wide spreads. So you end up taking bigger losses than you want, so smaller. Yeah, that's going to be the key, Christian. And again, anecdotally, I'm not going to get rid of my Netflix even when I do sign up for the Disney. So I don't think a lot of people were going to Netflix just for their kids. I think that was kind of a side benefit. I don't think they will get as big of a drop off in subscribers. It might slow down how many new subscribers they get, because obviously competition. I think the biggest loser in that wasn't Netflix. I think the biggest loser in Disney's announcement was actually Apple. And not Apple, the company itself, but Apple streaming. I think their streaming product is toast, personally. But I mean, I look at their streaming product that they announced, and I think I'm not going to get it. I wouldn't. I mean, there's a lot of nice names on there, but it's all original content. There's no franchises that people know. There's no franchises that I know. So you're going to have to, it's going to be like a wait and see to see if the content's worth getting. I think they're going to have to actually make their product free for people that use Apple devices. They're streaming. So I think any chance that Apple had of potentially charging for their streaming just went down the drain after that Disney announcement. And that's my opinion, but they're the ones that are the biggest losers. Yeah, I think they just have to roll it into what you're already paying, something you're already paying for. All right. Dennis. As per your bearish comment, have May UNH 230, 250. Do I manage and roll 250 down? I would wait for the earnings. I'm not I mean, that was a nice move on UNH. That was a nice move here. And there is very, very little support in this area, which is one of the reasons why it dropped so hard and so fast. You do have you do have kind of a big node here over the last couple of years. So I think the downside now is at least the extreme big moves and downside is limited. Of course, anything can happen. I would wait until the earnings. Obviously, if you're already at a loss that you can't handle, that's a different story. But if you're still within a loss where you still can stay in the trade, there's 250s the next, 240. You might be able to roll your 250 down to 240. I think 240 is a good area for resistance on the upside. Well, there was some weakness already, right? Healthcare is, all of our bearish trades in our verticals, they've all been, most of them have been healthcare related already. So, and they've been doing pretty well. Healthcare has already been lagging, and then, those 2 days for UNH were really down to the downside. I think your downside is more limited now, because we've gotten down to it. I didn't expect it to get down that in 1 day. I was actually thinking earnings would get us down there. So I actually think earnings might get you a knee-jerk pop, kind of a dead cat bounce. And depending upon how far up it goes, that 250 might be done. I think your 250 might pretty much be done. So at some point you could probably roll that down, and then move the 230 as needed when you need it. But yeah, you'll get, if you wait for it to bounce on the earnings, you'll get more. You'll be able to sell the 240 for more because you'll be closer if it bounces. But then you'll have to buy back your 250 for more too. I don't think it was exactly Bernie Sanders, Krishna. I think it was already in trouble. Healthcare's already been lagging. I think Trump's had some comments on the healthcare, and I think there's some expectations that healthcare is the next. I think there's some expectations that healthcare is the next area that you'll see some Trump focus from. That's been my opinion on it. So, all right. So yeah. So I think your 250 is done. I think you'd be able to buy that back and go for the two. I think you do have some resistance at 240 that you can change your strike there, and then wait on the 230 until after earnings. And just manage any downside risk in case it does drop. If it does drop on earnings, your next layer of any kind of support is going to be at 210. Right, these lows over here and this old high point and these lows, that's going to be your next layer, which is actually close. Today's low was 220, so you got about 10 points. So just manage your risk to see if that's something you can handle or not. All right. Sunita says if you have a I got a couple ahead of that. So I got Krishna's. Tax loss harvesting, I'm not as big of a. I'm not as big of a. I don't look into that as much. I don't know if Brandon does. If you give him a question, his Q&A, and how that can impact things. But no, I don't have. I would say I'm not as well versed in that to be able to give you a qualified answer on tax loss harvesting. Personally. And then lift options, I wouldn't touch with a 10-foot pole, Scott. The next question there is any play on lift options. It's hard because I'm a technical analysis kind of a guy, right? And so technical analysis is kind of dependent upon past precedent. There needs to be a precedent. And so when you don't have a lot of price history, then you don't have support and resistance. Support and resistance becomes much, much less of a factor because they're just, there's got to be price levels that people see. Now you can kind of see a little bit of a resistance level here at 75 if we were to bounce up on this. But like in terms of an options trade, I don't know, do they have very much? Do they have liquidity at all in these options? At the money, 30 cents. Well, not too bad. 40 cents over here. It's not too bad of liquidity. Boy, I would even like doing if you were to do something like this. I hate that. Sorry, my left hand is like practically worthless because of the my fingers. I can't feel the tips of my fingers very well. At least a few of my index finger, my middle finger, and my thumb, they're all kind of tingling and numb right now. There's no implied volatility percentile because we don't know, but it's pretty high volatility relative to others. I don't know necessarily if we are in an environment, Scott, where volatility is going to drop sharply, right? Because there is no past precedent here. But if you did this trade, it would give you a little bit more room to the downside to work with, and then it would kind of give you, relative to others, that is a high volatility level. It would kind of give you some room to work with to the upside. You got a little bit more room to the downside. You have earnings coming out before May. It's with that earnings, I wouldn't. Yeah, I wouldn't. I really wouldn't touch this right now, even for an options trade. It's if you were going to do anything on this, I would speculate out the wazoo on a highly directional trade, and just go with a really, really small trade, and see if you can hit the home run on it. Yeah, and just really small risk. Go for a big reward risk, and position size small. And take the loss. It's kind of like buying a lottery ticket. Take the loss. Take the expected loss. Be willing to take the expected loss, and then see if you can just hit a home run out of it. That's the kind of options trade I'd look at on this. Highly directional, highly speculative. So try, if on your call spread, try to get a really good. But I would wait as you get closer to here and let the market work itself out. I wouldn't do it right now because you don't know how much more downside it's got. So I'd let itself work itself out as you get into this earnings and then set something up. Try to get some more price history to work with, if that makes sense. I wouldn't do anything naked on this. I wouldn't even I would just do one directional call, long vertical, and don't worry about trying to cover the cost at all. Yeah. Yeah, exactly. I would agree with that too. That might impact your liquidity on this too. All right. Let's see. Sunita was asking about Disney. All right. If you have lots of ups in Disney and taxable account, would you take some off the table? That if it's in a taxable account, that's in a taxable account, that's going to be a factor in your decision, like how much you want to pay, and so keep that in mind, how much you're willing to pay and how much you want to pay. I do think Disney is an opportunity to take some profits off. I wouldn't reduce your position too much, but a move like this, again, you think about like dead cat bounces. A move like this, it's hard to sustain a continued rally without coming back and at least retesting like this 120, this low point. So you might grind a little bit higher here, but then you might pull back, and if it breaks 126, we might come down into this gap a little bit. So I think you do have opportunity to take some off the table here and look for an entry opportunity later when it's got a nice, because that's not a very good support. I'll show you what to talk about. See that gap? You see why gaps get filled, especially on the big time move. You see why gaps get filled? Because there's just no support in here. That's why they get filled, right? It gets filled down to the volume here on this. So I wouldn't. This is a good opportunity to take some off the table. Let it build a better support that you can bounce off of, and then enter in some positions. 115 covered call. Ooh. Yeah, 115 covered call. I don't think on what is your month on that one? May, the regular May expiration right there, I assume. Yeah, you don't have any extrinsic value left. It's going to be hard to roll. Even if you tried to roll this, buy it back. I think you're not going to get back below 115. So even if you try to roll it up to like say 125, whoops. You're going to pay a little bit of a cost to roll it up to 125 and reduce some of your. So depending upon what your credit was initially, you can keep some of your, but you still, you're going to give back $5 plus give back $7 unless it comes back below 125, which I think you actually do have a better chance of it coming back below 125. So you might be able to make back up the $5 that you're losing in intrinsic value, and then cut your losses on the rest of it to $7. Yeah. So when you get to less than 10% of extrinsic value, it's hard to roll it. It's hard to roll it and not have to pay a debit. So you're going to give back some credits on that. And like I said, 125, I think there's very little support at 125. So, and especially with the earnings coming up on it, there's little support there. So there's a good chance we can get back below 125 and still not be bearish, right? And still just come down to support. Well, this would be a rolling trade, right? So you would roll your 115 up and down. So you'd roll it from May to June and from 115 to 125 and keep the stock. Right, and then now this gives you a better chance. Now you have to give back $7 to do that. So it depends on how much credit you got since like you said you've been managing it since January. You might have to get back some of your credits there. But this would allow you to keep the stock, right? Because right now you're by doing this you're keeping $10 of gains. You're paying $7 to keep $10 of gains. Right, going from 115, instead of selling at 115, now you're selling at 125. So you're getting $3 essentially, almost $3, $2.30 you're getting $2.30 to move your selling price. And so, but right now you're at 130, so you've got $5 of intrinsic value that you're losing and unrealized, but there's a good chance that can pull back down to 125 and you get to keep. So so it says it's a debit. The reality is, you're gaining $10 on the stock to offset this. So really it's about a $2.30 gain that you're getting, but you're getting it on being able to sell the stock at a much higher price. And you might not have to sell it at 125 if we pull back down. I mean, you can do an earnings triangle separately. You don't have to get out of one trade to do another trade. You can do that earnings triangle separately. If you want to keep the stock, this is a rolling it. If you want to keep the stock, this would be the roll. Like I said, because right now you have your gains to 115, right? You have your stock gains to 115. You got your credit for 115, and right now you would sell the stock at 115. That's what you have right now. So what you do is you can to sell it at 120. You can make another $2.30 by rolling it up to 125, because you get $10 more on the stock. And you have to pay $7.65 to do it, but you get $10 more on the stock. So net, you get another $2.35 out of it. Now you sell the stock at 125, but you have decent odds, because look, at 125 you have the extrinsic value is almost half of the value. So you have decent odds that you might not even have to sell the stock at 125. That it might pull back below 125 towards 120, then bounce and move. And so yeah, the earnings triangle you can just kind of do separately. You don't have to close out the one for the other. And you do have really, really high, like I said, so a lot of times you do get a reversal type move coming out of that, and then it will just flatten out. Because they announced it, they announced the service, but they haven't started the service. So there's expectations of a lot of subs, but they haven't seen. We don't know how many subs they're actually going to get. So that's the idea. It's going to be hard to really get going on this. Now you've got how much money is Endgame going to make? How much money is Star Wars? I mean, Star Wars will come out after that service comes out, but you got Endgame, you got Spider-Man in the summertime. I mean, you've got the parks opening up, so you do have some things that can drive it higher, but I wouldn't be. I mean, you got very, very little support below 125. I think that's a good rolling for you. It will cost you some money. It will give you a net $2.35 to raise your sell limit order, essentially, and give you the potential to keep the stock if you want to keep the stock and let it keep trending. All right. And let's take one quick look at Google before we wrap it up. From a tech, I mean, you've got a little bit of a, you broke out, you got a little bit of a triangle here, and you've got the potential for, bullish moves to the upside coming out of that triangle. That's the expectation you would have coming out of that. So you have the trend coming up. Here's your consolidation pattern triangle. And then now you're trying to break out. Very little resistance up here. You do have some at 1265. It's not going to be very strong, but you do have some up there. So keep an eye with that earnings coming up of whether you can break out of that or not. And I would venture to guess that the market would have to probably by then would have to also be breaking out to new all-time highs for Google to be able to do so too. They probably would be moving in conjunction with each other. All right. That wraps us up for today. And I know that's all of our questions there. And I know it's not a typical 2-hour session, but I appreciate you staying with me here today and for the topics of conversation. I appreciate the well wishes there as always in the chats and the emails again. Got to stay on those meds to try to keep this fire put out here in my arm. But have a great rest of your weekend, everybody, and We'll see you all in our next class next week. All right, goodbye, everyone.